Welcome to Breaking News to Trading Moves. Today we're looking at a development in financial technology, specifically around how products are distributed and how consumers pay for them. There's been an acquisition that touches on employee benefits, consumer credit, and even retail.
Right. And our job is to basically figure out what this deal means for companies all across that spectrum. Payroll, retail, lending, you name it. We have one core transaction to examine. PROG Holdings, that's traded as PRG, has just closed a key acquisition. And we really need to analyze how this change in distribution affects the whole financial ecosystem. Who wins and who might be facing some new competition.
Okay, let's get right into the main event here. PRG Holdings, PRG, has finalized its acquisition of a company called Purchasing Power. The details seem pretty straightforward. It was a $420 million price tag, paid in cash, which PRG funded using both cash on hand and some debt financing.
And the mechanism here is really the crucial element. Purchasing Power, it operates as an employee benefit platform. It lets W-2 workers, salaried employees, buy durable goods and services. And the key part is how they pay for it. The repayment is all handled through automatic payroll deductions.
So it's not a credit card, it's not a typical loan, it's coming right out of their paycheck.
Exactly. This platform brings with it a huge, already established employer network. So PROG gets access to literally millions of employees through hundreds of existing partnerships with companies. The whole value proposition is a payment system that is, well, it's incredibly reliable because it's baked right into the payroll process itself.
Right. So why is that setup so powerful? For you, the listener, the importance here is really in understanding these specific mechanics of distribution and repayment. This is more than just PROG adding a new product to its lineup. It's a kind of an upgrade to their entire business model.
It is. When we look at why the market pays so much attention to these payroll deduction platforms, it really comes down to better risk management and efficiency. The key difference isn't just that the deduction is automatic, it's that it happens upstream. It's before the money ever hits the consumer's bank account.
That's a critical distinction. It's not a scheduled withdrawal from a bank account that might bounce if other bills get paid first.
Right. This is not some post-dated ACH that might fail. This money is taken out before the employee can even spend it. And that certainty gives them three major advantages that really define their market position. First is lower customer acquisition costs, or CAAC.
Yeah.
Instead of spending a ton of money on, say, social media ads to find one consumer at a time, PRG is now tapping directly into these big, established employer channels. It's a distribution shortcut, and it dramatically cuts the cost to bring on a new user.
And I imagine the second advantage is that repayment predictability you mentioned. If the money's deducted from payroll before anything else, repayment is just going to be much, much steadier.
It changes the risk profile completely. It allows for better pricing, better terms.
Which leads to the third point, I'm guessing.
It leads directly to the third point. Deepened usage. Because the system works so well for both the consumer and the lender, the platform can support more repeat purchases. They can even handle higher ticket items without taking on a ton more credit risk.
It sounds like an almost perfect system. But we have to talk about the risks involved. What are the potential downsides for PRG Holdings?
Well, the deal was done using debt financing, so you have to consider the added leverage on their books. And the successful integration of Purchasing Power into the broader PROG ecosystem is absolutely crucial. If they fumble that integration, they won't get the cost savings or the revenue synergies they're hoping for, and that extra debt could become a real problem.
Okay, let's move on to the market effects. Starting with the companies that are set up to gain from this, we've sort of broken this down into three main categories of beneficiaries.
The first category is really the employer channel fintech distribution space itself. The fact that a big player like PRG is putting this much money into this kind of model, it validates the whole strategy of embedding financial products into employee benefits.
It sort of lifts all boats in that sector.
It does. And the names to watch here are, well, obviously PRG Holdings, PRG, since they're the ones making the move, but also a company like SoFi Technologies, ticker SOFI. They're already active in lending and distribution through the employer channel. This just confirms the value of that approach.
Okay, so who's in the second group of beneficiaries?
The second category would be the payroll and HR platforms. These are the companies that actually own the rails, so to speak. So think about automatic data processing, ticker ADP, and paychecks, ticker PAYX. For them, these new embedded fintech partnerships are a great source of revenue.
How does that work exactly? How do ADP or PAYX benefit? They aren't doing the lending?
No, but when a service like Purchasing Power gets integrated, it needs API connections, it needs seamless data flow with the payroll processor. This makes the platforms from ADP and Paychex stickier. The more of these complementary services they can
The
offer,
harder it is for a client to leave.
precisely, it makes their platform more valuable and cements that relationship with the employer. It becomes an ecosystem.
That makes perfect sense. And the third category is retailers. How does a deal like this help, say, a Walmart or a Best Buy? Tickers WMT and BBBY.
Well, certain retailers get a direct boost if these payroll deduction programs get bigger. This kind of mechanism can pull forward demand for durable goods for those higher priced items. You have to think about value conscious shoppers who might put off buying a new TV or a computer because they don't have a simple, structured way to pay for it over time.
But it's not just about making a purchase easier. It's about enabling a purchase that might not have happened otherwise, at least not right now.
Exactly that. It gives retailers access to consumers who are employed, who are stable, but maybe have a thin credit file or just prefer not to use a credit card for these kinds of plan buys.
Okay, so if those are the companies gaining an edge, we have to look at the flip side. Who's now facing more competition? This payroll deduction channel, it creates a real substitution risk, doesn't it? A whole new lane for consumer spending.
It does. And the first group that's going to feel that pressure is the BNPL and checkout financing competitors. The substitution risk for them means that if a lot of these installment purchases move away from the online checkout screen and into an employee benefits portal, it just cuts directly into the market share of the established buy now, pay later companies.
And we're talking about the big names here, like Affirm Holdings, ticker AFRM, and PayPal, PYPL, which has a huge BNPL business. This payroll model just goes around their point of sale position.
Yes. Next up, you've got the card issuers and general consumer lenders. These companies are exposed because their revolving balances, their purchase volumes, they could see some weakness. If consumers start moving discretionary spending over to these new payroll deduction plans, that's spending that's not going on their credit cards.
So if I decide to buy a new couch through my employer's program, that's a big purchase that American Express, AXP, or Synchrony Financial, SYF, didn't get a piece of.
That's the mechanism. It can reduce their near-term purchase volume, especially with those consumers who are already trying to manage a tight monthly budget.
And what about the last category of competitors, the higher risk consumer credit plays? You said this one's a bit more nuanced.
It is. Payroll deduction plans, by their nature, are targeting W-2 workers with stable jobs. So by definition, they are going after a group with predictable income and lower risk. This is, the high-quality end of the consumer credit pool. So by siphoning off this higher quality group, other lenders, maybe like an Upstart Holdings, UPST, or One Main Holdings, OMF, they are left competing for the more marginal borrowers.
So the acquisition basically makes the competition for the best borrowers even tighter.
Yes, it can raise the average risk profile for everybody else who is still in that lending pool.
Okay, let's pivot to what happens now. With all of this in mind, what are the most important things for our listeners to be watching?
The immediate market focus is going to be squarely on the buyer, on PROG Holdings, PRG. And you need to watch three specific things. First, how well do they execute the integration? Can they combine these systems without any major hiccups? Second, can they actually cross-sell successfully into this new employer channel? Can they generate new revenue from this user base they just bought?
And the third point has to be the debt, right? Given how they financed it, we need to see how that new debt load affects their forward guidance and their credit metrics over the next few quarters.
That's it. That will tell us if the deal is adding to the bottom line right away or if it's going to be a drag for a little while. And beyond PRG itself, you'll want to watch the broader reaction across the fintech and lending sectors. The main question is, does the market see this deal as a positive sign that strong distribution like payroll access creates a lasting competitive advantage?
And if it does, that might make the valuations for other fintech companies with similar distribution channels look more appealing.
Or, on the other hand, does the market see this as a negative for companies like Affirm and PayPal?
Well,
Does it validate the concern that new forms of competition are coming in and eating away at their core business model, which is centered on the checkout screen?
right. That tension is really what's going to drive the story for the next few quarters.
It is.
So a single $420 million transaction really shows how access to fundamental payment rails, specifically the payroll system, can adjust the competitive landscape for dozens of companies.
And it leaves us with one final thought for you to consider. Knowing how valuable these payroll deduction customer groups are, how fast will other consumer lenders try to build or partner their way into this channel to get access to those same high-quality borrowers?
Please note that the information reviewed here is purely the opinion of the author of the material discussed.
This is not financial advice, nor is it a recommendation to buy or sell any security.